Hi, class. Welcome back. This is part two of the Wednesday, April 6th, 2022 macro lecture, and the Friday, the 8th, April 2022 macroeconomic lecture. We're going to start chapter 10. Now, chapter 10 is where we really, at this point, begin to interconnect a number of concepts that we went over previously and new concepts. And we'll be very shortly moving into much more in-depth physical policy and monetary policy. But chapter 10 primarily addresses growth, the financial system, and the business cycle. Now, in terms of what we've covered before on growth, we went over the calculation of growth in terms of nominal GDP, if you recall, real GDP and real GDP per capita. And just as a reminder, remember, anytime you hear or read the term real GDP, real interest rates, real wages, that's just economic speak for adjusted for inflation. And we have three ways of measuring GDP. One, of course, is nominal GDP, which if you recall, and I hope you do, it's deficient in that if you use just the nominal numbers of all the prices of the goods and services that were produced in the economy in that, say, calendar year, if there's any inflation, even a de minimis amount of inflation in terms of like 1%, it's going to give you an inflated and an erroneous picture of the growth that took place. So we use a formula, a deflator, which basically adjusts for inflation, which gives us real GDP. And real GDP is a much more accurate indicator of growth. Another formula for calculating growth is real GDP per capita. And real GDP per capita can be used comparatively. If you recall, I gave you a hypothetical where we assumed, and it's not ever really so, that our GDP, nominal GDP, real GDP, and real GDP per capita is the same as China's. And you find out real GDP by dividing it by the population of the nation. Per capita is basically per person. It deals with populations and demographics. So if you look at the same number, say, in whatever trillions of dollars, and it's divided by 330 million people, you're going to get one number that looks pretty attractive. If you take that same number in terms of real GDP, nominal GDP converted to real GDP, and you divide it by 1.4 billion Chinese, It's an entirely different picture of how the growth in the economy in that given calendar year provided new and additional products and services to the society, the given nation state. And of course, when we, look at these numbers, they can be deceiving because we try to evaluate growth in terms of, what is the standard of living. Another way of looking at it, and I'm sure you recall, is, and it's a much more broader perspective, what is the overall well-being of, a given nation state or society. For example, where there's catastrophe, where there is disaster, if you take that area as a microcosm, um, and you evaluate all the economic commercial exchange that has taken place, one would say, oh, there's a very high standard of living here because there's a lot of additional services and products being added to whatever that microcosm is that previously suffered disaster. But when you look at the context, for example, Hurricane Katrina or 9/11 in downtown Manhattan, you look at Hurricane Katrina and you think, well, during that period of time of rebuilding, would you have wanted to live in New Orleans? Probably not, because in actuality, the standard of living, while the numbers would indicate that it would be very high, it probably wasn't anywhere near what those numbers would indicate. Likewise, if you look at it from the context of well-being would actually be very low. So real GDP per capita is theoretical. It's theoretical in the sense that there's all these additional goods and services added to the economy that theoretically each person has available to them. But we know what is dispositive of consumption is disposable income. However, the general trend is that when an economy grows and adds, assuming you don't have a huge, positive population shock, assuming that population is relatively static, you you will have a situation, given the fact that more supply of goods and services are added, that prices will traject downward, so that more people will actually be afforded those additional goods and services. Not necessarily all of them, but we use real GDP per capita as a rough barometer, a rough indicator of the standard of living that is taking place in the economy at that time. Now, one of the great potentiators of growth, of course, is the consumption function. Aggregate demand, is an inducement for additional supply. When you have additional supply, you have growth. But always remember the caveat. It's not that simple. Supply side may very well be attracted to those higher prices because of demand pull inflation. But in order for that supply to truly get to the market, you're going to need a favorable system of taxation and a favorable regulatory establishment that doesn't add a lot of transactional costs to the businesses that are trying to bring supply to the market or create inertia. Because again, if you have a regulatory apparatus that applies to your industry, you know, and it's holding you up from getting supply to the market, you may not win the prize. Because ultimately, what happens when you have that demand pull inflation and you've got more supply going into the market, it's only those that actually get there first that are going to get the higher prices. As more supply comes to the market, it's gonna start pushing prices back down to equilibrium. So always remember that it's something that textbooks kind of gloss over, and there's no real focus on what impact um, tax structure and regulatory structure has on on the supply side, efficiently getting supply to the market. That's something I can't stress enough. What we've covered so far was really, when it came to growth, was really aggregate demand and the potentiation of growth with aggregate demand and consumption. Now, two-thirds of the engine of our economy is short-term growth due to aggregate demand. Um, it's necessary, but by itself, it is not sufficient to actually effectuate economic growth. Because when we look at growth in the economy both in the short term and in the long term. What really determines short term economic growth is that uptick in prices and demand pull inflation, or new markets. New markets will have the same effect, that more supply is ultimately being delivered to the economy. But in terms of actually increasing the capacity, the commercial, the productive capacity of the economy in the long term, it's highly determined by the savings and investment function that takes place in the economy. Now, you remember that little mnemonic device that I mentioned to you a few times going back earlier in the semester. C for consumption, plus I for investment. Keep in mind that investment also involves savings. Plus GS, government spending. GS primarily as a consumer, government as a consumer of private sector goods and services, plus exports minus imports equals roughly aggregate demand, roughly equaling GDP. Well, that savings and investment function is utilized by businesses in terms of potential growth. The money that you and I, for example, just to look at the banking system in a very peripheral way, the banks take in our deposits, which of course are bank liabilities. Why? Because we can, it's a demand deposit. We can no sooner deposit it than withdraw it. So it's a bank liability. And they pay us an interest rate that's applicable to interest rates at the time. And they take those monies, and of course, what they're going to do is they're going to shave off the top whatever the reserve requirement is that is set by the Federal Reserve. And the rest are going to be loanable funds, excess reserves, meaning the bank can lend them out, or they could use those funds for purchasing investments that they store in their investment portfolio. But those loanable funds are quite important. They're quite important because that is what the supply side actually relies upon for the purchase of capital plant. How do you finance businesses? Well, I mean, it kind of depends upon what the form of business is. If you're a subchapter C corporation, you've got some options afforded to you. You can go to the bank and purchase loanable funds. You're using the banking system to borrow. That's debt financing. You owe the bank the principal plus the interest. A subchapter C corporation can also use debt financing in the form of issuing bonds. The relationship between the bond purchaser and the subchapter C is that the subchapter C is the borrower, and we, John Q. Public, when we purchase those bonds, are the lender. The bonds are rated. There's like 3 different rating agencies: Standard and Poor's, Moody's. I'm having a senior moment, whatever the third one is, and they rate the bonds. And when the bonds are rated very highly, the interest, the coupon payment is the terminology that's used, may not be all that attractive because it's a low risk investment. When the bond rating entities rate bonds lower, and there's at least perceived risk for the lender, the interest rate that you are paid on that loan is higher, but there is more risk. And basically what happens is that there's a maturation date. You know, at the maturation date, you will get back, or hopefully, depending upon the rating, you know, uh, you know things could happen. Um, you will get back your principal and any fraction of accrued coupon payment interest that is lying around. However, during the interim of that loan, vis-a-vis a bond, a corporate bond, you will receive interest payments, as I said before, denoted as coupon payments periodically over the length of that bond. Another way a subchapter C corporation can finance its growth is in equity financing. It could issue additional shares of stock. Please note the difference between the primary stock market and the secondary stock market. If a corporation that is a private corporation, maybe it's a subchapter S, maybe it's a partnership, whatever the business entity is, and they're going public, at the initial public offering, that is equity financing. You're selling ownership shares at a particular price to raise equity for the purposes of, and we'll keep it growing the business. And that may mean a number of different things for different industries. If you have those shares, and for whatever reason, maybe you just personally need liquidity, or maybe you're not that impressed with the performance of those shares, you can sell them in the secondary market. When you sell them in the secondary market, that's really not equity financing for the corporation. The secondary market exists in order to make the primary market palatable. Meaning, I can go and I buy stock at an initial public offering, and for any idiosyncratic reason, legitimate or illegitimate, whether I need liquidity or I don't need liquidity, or I'm dissatisfied with performance, I can always very conveniently sell that stock in the secondary market. So the secondary market makes the primary market an attractive investment. Another way outside of an initial public offering is that the board of directors and make a determination to issue additional shares of stock. Again, those additional shares of stock are being bought, and that money, those is used directly by the corporation. What's bought and sold in the secondary market may reflect the value or the future value of a corporation, but it's not equity financing. Equity financing takes place in the primary market, and it takes place when a corporation issues additional shares of stock. So those are the three options that a subchapter C corporation has for raising revenue in order to purchase capital plan to expand the business. Now, I will note one thing to you. When it comes to bonds, under law, bondholders are, in the event of bankruptcy, or there's going to be a liquidation. The bondholders get priority over shareholders, so there's a little bit of safety, a little bit with bonds. So there's a lot of different ways a corporation can raise money. You've got two forms of debt financing. They can go to the bank and get a loan. They could issue bonds, and they're the borrower, we're the lender, or they can have equity financing. There's another form of financing, and it's called the leveraged buyout. And leveraged buyouts, and I will tell you, some people are under the impression leveraged buyouts only occur between, subchapter C corporations buying an attractive target business. It doesn't. That's not necessarily always so. Remember, we could have an interest in a target business and not have enough financial capital to purchase the business. So what do? We go to the bank. Of course, we have a valuation done, and that valuation of the target business will be utilized by the bank. The bank will also have their own valuation done, which we will pay for. And if those valuations basically are in sync with each other, the bank will lend us the money and use the assets of the target business that we're purchasing as collateral. That's important because we may not want to risk our personal assets. And not all businesses, target businesses that are being sold, are really in the realm of getting financed with a leveraged buyout. I mean, what the bank is going to look at, really, the valuation companies that do the valuations, is that they're going to look at whether the business is asseted, meaning that the business holds real estate property in the business name. They're going to look at, unfinished inventory, finished inventory. They're going to look at accounts receivables. And again, accounts receivables, having chock full of, uncollected accounts receivables that you're basically selling to third parties for the purposes of collection is not really, That's not something that's conducive to a leveraged buyout. However, if you have accounts receivables, and regardless of the terms, 30 days, 60 days, 90 days, 120, if those accounts receivable have a history of paying and you have considerable cash flow, you're going to find, you're going to find that that is a big plus in terms of acquiring funds for the purchase of the target business, vis-a-vis a leveraged buyout, because that business is so asseted and lucrative that, I mean, basically, if the borrowers did not pay and the loan goes into default, more likely than not, what the bank would do is, appoint, a trustee, a fiduciary to run the business, and they would get paid. They would get paid that way. So again, a subchapter C corporation has its choices in terms of financing. If you look at a subchapter S corporation, again, a subchapter S, you should know, has, it's about 100 shares. It's not private. It's not publicly traded. It's privately owned. And of course, they can always go to the bank, which is an intermediary, and get debt financing. Um, Given the fact that they're limited to 100 shares, if there are shares yet to be dispersed, they could maybe, say to the person that they're interested in selling the shares to, you know, we're interested in doing business. Here's the shares, and they're purchased with equity. So there is equity financing that can take place in a subchapter S corporation, but to a very de minimis amount. Very, very, very limited. And they have debt financing. In terms of bonds, it's not happening. If you look at, say, LLCs, basically the same. Depending upon the state, some states have, a limit on the number of members, but they could always take on another member, which brings equity to the firm. Or they can debt finance, borrow money from, from a lending institution, which again, for all economic purposes, banks are just intermediaries when it comes to collecting funds from a multitude of depositors and lending this money out, um, whether it be businesses or whether it be individuals. A partnership, if it's a general partnership, you could always, take on another partner and they bring equity, you got debt financing. Limited partnerships are wonderful vehicles for investment, especially for people that don't want, to deal with, the everyday trials and tribulations of um, of management. A limited partner basically brings equity to the firm, um, and gets a specific return on investment, hopefully, um, and doesn't have to deal with management. So the partnership, again, debt financing, equity financing. When it comes to sole proprietorships, which a large percentage of our businesses that exist in the United States are in fact sole proprietors. You know, they're really kind of limited to debt financing. That debt financing could be, you know, very formal lending institutions, or it can be from friends, it can be from relatives, um, what have you. Um, they can also utilize, as other businesses can too, retained earnings. Basically, what you're doing is you're taking profits and you're redirecting profits back into the firm for the purpose of growing the firm. You're basically taking profits that are financial capital, and using them to grow the firm. You know, businesses can do that. I mean, a sole proprietorship. It's debt financing and or retained earnings in order to grow. But from that business side is where you see the long term growth, meaning you have the addition of of capital plan. Again, remember what capital plant is. It's machinery or devices that are utilized in making a product and or delivering a service. It's not just machinery in a factory, although that's the typical model that is utilized many times in textbooks. But long-term economic growth is really growing the supply side. Businesses are expanding. Businesses are hiring human resources. Compare that to short-term economic growth, which is primarily the consumption function that's taking place in the economy. And that, for all intents and purposes, really has no longevity to it. Like, if you look at the business cycle and you look at the peak, well, yeah, like that's great. The peak is wonderful. You're doing pretty well then. And then you can have a contraction. You go into a recession, and then you have the expansion. Well, what's dispositive of the height of the potential peaks and the longevity and momentum, how robust the expansions may be, is the amount of capital plan that exists in the economy at that time. So when we look at long-term growth, we're looking to add businesses. That's what we're looking to add. Whether those businesses are sole proprietorships or all the way up, whatever form of business, from sole proprietorship right up to subchapter C. Long-term economic growth is not just the addition of new businesses, but the expansion of already existing businesses. So keep in mind, when we talk about consumer confidence being important in terms of the demand function, business confidence is very important in terms of how far we're going to grow. Because if you don't have business confidence in terms of expansion, um, whether you defined expansion as expanding existing businesses or adding new businesses and coupling that with expansion, unless that takes place, the economy basically stagnates. So, notwithstanding the fact that the savings and investment function is only 1/3 of the economic engine, it is most certainly, when it comes to long term growth, exactly what we need in order to have growth that's going to take place over decades. Now, I know the textbook, indicates how life was different in the 1900s right to the present day. Yeah, growth. I mean, we basically kind of look at growth in terms, once again, decades. Not because there's changes of consumer price, tastes, and preferences, but we're looking for not short-term spurts. They're wonderful to have, but we're looking for some additional capital plan being added. So, yeah, that's a nice notion, to see, that we grew by 8 times as much from 1900 to the present day. Um, but that is not all on the demand side. In order to have that eightfold growth, you're talking about adding businesses and expanding other businesses. Sometimes, even policymakers focus so much on the demand side that they have a tendency to overlook the significance of long-term economic growth that comes from the supply side. And generally speaking, if you look back and you look at the Industrial Revolution, it was really with the Industrial Revolution, both, in Europe, in Great Britain, and in North America, in the United States, that really were the first real instances of economic growth. And again, what is really paramount was you went from artisan societies where the production of goods or the providing of services, but more specifically the production of goods, was slow and methodical and not voluminous. Switching from an artisan society to mass production, utilizing specialization, division of labor, whatever technology that existed in order to create a better scale of productive efficiency, led to mass production. If you basically have, a population that has a particular demand function, And again, I'm not talking about, precisely, but, the demand function and the size of the population being the same, and all of a sudden you introduce additional supply, it pushes prices down. So that was economic growth. Now, usually concomitant with economic growth, you see, which again adds to well-being and our standard of living, is you usually begin to see scientific and medicinal breakthroughs that, life life becomes healthier, and you also begin to see technological breakthroughs that make life easier. For example, like the difference between a typewriter and a laptop. It's you'd have to use a lot of whiteout if you made a mistake. With software, it's you got spell check, you got grammar check. I mean, there's a whole load of conveniences that come along with the advances in technology. So when we look at growth and we talk about the standard of living and we talk about, an increased sense of well-being, we also look at, at health. What is the general health of the nation state, of that particular society? What also are the devices that is making life both easier and more productive? A third aspect of growth is that you create such scales of productive efficiency that you're producing more in less time and at less cost, that as a result, your average person has more leisure time available to them and has, sufficient disposable income where they can enjoy their leisure time, whether it's going to a baseball game or whether it's going on vacation. So, increases in health and health sciences, increases in technology that makes us more efficient and life generally easier, and increases in leisure time. And not just theoretical leisure time, but not only the leisure time, but the affordability to use it in a manner that you choose to. Like you can afford to do these extraneous events outside of, just think about, at the beginning of the Industrial Revolution, you know, um, labor, you didn't have the Fair Labor Standards Act. You didn't have, you didn't have, you didn't have labor protections, and of course, work days were very long. Work weeks were very long. Um, in terms of wages, wages many times, if not most of the time, were not were not in any way remarkable. They were somewhat meager. So you look at the Industrial Revolution, and that's the starting point. Even though it had its many vices, Health was not overall good. Um, People didn't have much leisure time. And if they did, they didn't have sufficient disposable income to make it worthwhile. There were some technological advances, but they were geared more towards um, capital plant in businesses. But as time went on, we started to see greater and greater and greater and greater increases in wages, and you saw the child labor laws enacted. You know, during the New Deal, you had the Fair Labor Standards Act, and you had by 1938 you had minimum wage. There was a plethora of paternalistic, but now, and I don't say that as a pejorative, paternalistic legislation that made work life at least easier for the average worker. Um, One of the things that we do focus on is the arithmetical, the computation of of growth. Now that you know quantifying growth is is something that has to be placed in perspective. And when I say placed in perspective, it has to be viewed in the context of, are there really increases in the standard of living? Um, are there technological conveniences that are being appreciated by the general population? And is leisure time really coming about because of, and should be twofold. Number one, productive efficiency in terms of the output of hours, and also an increase in disposable income. But the rule of 70, which is utilized all the time, it's in your PowerPoints, it's in the text, um, basically takes a variable, like in the PowerPoint, they use a growth rate of 5%. And 70 is divided by that 5%, and it gives you 14 years. Now, roughly speaking, that is what it's going to take for the economy to double in size. Again, we're looking at real GDP per capita. When we say double in size, we're talking about a population that's, again, relatively static. Relatively static. We have 330 million people in the United States. If we had 1.4 billion like China, our real GDP per capita would be much different. So again, that population, that is important. That it's not, you're not going to have some type of population explosion, a positive population shock. Those added goods and services should translate both to a higher standard of living and a better sense of well-being. in terms of health, in terms of safety, in terms of leisure time, where people are enjoying life more than they did 100 years ago. I mean, I know I mentioned this to you before, but, prior to the Industrial Revolution, you really did not have economic growth. So, the Industrial Revolution, we're looking at, the late 1700s. If in 1700 you were alive, your standard of living was not in any appreciable way much better than the standard of living than your ancestors in the 1600s or the 1500s. But, once we started, to utilize the concepts, that were espoused by Adam Smith as being the variables, the factors, in the wealth of nations. Why did some nations grow and other nations not grow? Well, what he observed is there's scales of efficiency in dividing up tasks and specialization. There's scales of efficiency in utilizing capital plant that is labor saving. So we're looking for, in essence, what we've talked about all semester long is productive efficiency. Increasing output at lower costs has a shortcut definition. Now, of course, you can't look at productive efficiency in a vacuum. That's crazy. You have to look at allocative efficiency too. But assuming that we do have allocative efficiency firms, regardless of their form, is sensitive to the needs and the wants of the population in which they have a customer base, and they're looking to succeed, they're going to provide what is at least perceived to be wanted and needed at that time. That perception may be incorrect, but allocative efficiency, in essence, is making the consumer happy. You couple that with productive efficiency, and that's where you really start to see economic growth taking place in a free market system. What's important to growth, again, is that, capital in terms of goods. Now, I mentioned to you previously in the first part of this lecture that, when it comes to, consumers, one of the demarcations of a healthy economy is the number of durables that are being sold, because it indicates a better than just sufficient level of consumer confidence, especially the new automobile. When new automobile sales are up, it looks good. Secondly, when it comes to capital plant, new orders for capital plant is equally, if not even better, an indicator of growth, because the supply side, the firms, have really surveyed the terrain and have made a determination to invest either in a startup or expanding existing businesses. And the profit motive really kind of hones that decision making. So one of the things that we look for is new orders for capital plant. Now, and again, when you look at capital plant, that of course involves technology. And technology it can be a double-edged sword. Like I've spoken to you before um, about creative destruction. And creative destruction is not it's not new. It's not like what's contemporary today. There's always been some level of of creative destruction taking place. Again, once we had the Industrial Revolution, you know, you have labor saving devices displacing labor um, labor intensive activity. And yes, at times technology can displace human resources. But there's also times that technology makes human resources more productive, and you don't have to worry about structural unemployment. When you have creative destruction, literally, where a machine replaces a human being, you always have to have that concern, you know, what happened what happened to that worker, and is it adding to structural unemployment? But where you have technology that is an additor, it just makes the human resource that much more productive, but doesn't displace the human resource. That's kind of like the best of both worlds. So technological change is something that we're going to experience ad infinitum. It does occur. I mean, if you want to look at you know technological change from an historical perspective, there are spurts, and then there are times of seeming inertia, spurts again, and you have sometimes very substantial changes that take place in the industries that the technological change impacts. But nevertheless, I mean that is ultimately a necessary component of economic growth. You're not going to have economic growth unless you have technological change. And it's not, and again, I mean, because I know I've talked to you about this at length, the perils of structural unemployment, because it's something that, I've taken a personal interest in. Um, but all technology is not necessarily displacing human resource labor. It can actually just be something that makes the human resource more efficient. For example, like the difference between, as I mentioned before, the difference between a typewriter and a laptop in terms of the word processing software. I mean, what's more productive? Of course, the laptop with the word processing software. If you compare that to you know you know the the trials and tribulations of changing ribbons and, making errors and using whiteout. And, you can do a lot more and be a lot more accurate with a laptop. Now, the laptop didn't displace, at least not that I know of, the human that is ultimately operating it. So try to have not such a jaundiced view of creative destruction and technology, because I might have given you that by focusing on the downside of structural unemployment. And if I did, I didn't intend to. It's just that, there is and there can be a downside to technological advancement. That downside to technological advancement, just so long as those that are displaced have the ability to be retrained, re-educated, and re-employed in a relatively short period of time, is innocuous. It only becomes pernicious when there is a fissure between, the introduction of technology, the structural unemployment of the human resource, and then an inability for the human resource to be rather expediently reemployed again. That's where it becomes problematic. Now, we distinguish between real GDP and potential GDP. When, and this is not, I think the textbook overcomplicates this, but it can be broken down this way. When an economy is at potential GDP, it is very efficiently using capital plant, human resources, it has full employment, and it's growing. So when you synchronize potential GDP with actual GDP, the economy is doing extraordinarily well. When you have an approximation, more often than not coming out of the Bureau of Economic Analysis, of potential GDP, and the economy is not able to reach potential GDP, it could be because the economy is teetering towards recession, or there's some inefficiencies that are taking place with the utilization of technology, or more specifically, maybe you're not utilizing technology. Productive efficiency is not what it probably should be. Even for that matter, allocative efficiency may not be what it should be. So when actual GDP falls short of potential GDP, the economy is inherently, regardless of the causes, slowing, and could very easily teeter into a recession. Now, when you have potential GDP, And the economy, in terms of its level of productive efficiency and allocative efficiency, even slightly exceeds the potential. Usually you're dealing with a case of inflation. More often than not, when actual GDP has surpassed the projected potential GDP, you're usually going to have some inflation. Now that could very well be with within the limits of the 2% target rate of inflation of the Fed. And for that matter, the economy has got more demand than it does supply, and those higher prices should, again, assuming tax structure and regulatory structure is not onerous, easily bring more supply to the market. So that edging up of demand and the meeting of that demand with additional supply, as long as you bring that supply to the market, you're not going to necessarily deal with inflation, demand pull inflation that has any longevity to it. Initially, you might. You might. You have to ask this question. Would you want to live in an economy that's ever so slightly teetering beyond potential GDP? There's demand pull inflation, and you have a real interest on the supply side, meeting supply, or live in an economy whose actual GDP is less than potential GDP. I would take the former over the latter. I'll live with a little bit of inflation, as long as we have a sufficient level of economic growth. Now, the financial system. Keep in mind that when we look at the financial system, or I should have mentioned to you, or I meant to mention to you, we're no longer on the gold standard. Money, as it exists today, is fiat money, meaning it's utilized merely as a means of exchange, a modality of how we go about exchanging products and services for what? Money. Without a medium of exchange, without the modality of money, the economy would basically be then reliant on barter. Now, barter, if it coincidentally, meets the double coincidence of wants, meaning I want something that you have, and you want something that I have, and we trade it. There's a double coincidence of wants. The exchange takes place between us, and your standard of living and my standard of living is enhanced. If, however, and this is in the absence of a medium of exchange, this is why we have money and financial systems, um, if you don't get the double, and again, coincidence, that's the operative term of wants, the exchange doesn't take place, and ultimately, the standard of living begins to diminish. So what we're going to do is, when I'm back in class, and I will be back in class, yeah, I get this. I'll be back in class by Wednesday the 13th. We'll start looking at a little bit more extensively, the banking system. We'll look a little bit more extensively at M1, M2, which are near monies, and of course M3, that no textbook covers. I don't know why, but I like to cover both M1, M2, and M3. And again, those are segments of the money supply, the medium of exchange. But in order to understand the financial system, I'd like to just give you that background. Um, the embedded code is, and for part two, this is part two, and Costello. And AND, Costello, Costello. So if you watched both lectures, what code are you going to give me? Abbott and Costello. Again, please make sure you do that, because I have to take attendance. I have to. If I don't get back from you, your little note to me giving me the code, I can't just surmise that, oh, okay, you saw the video and mark you present. I can't do that. So, I've used this code system before very successfully. Hopefully it works this time. This is um, a one-time utilization of this YouTube video lecture. But it did work both in the short run and the long run when I used it before. So hopefully it will work. Again, if you have any questions, reach out to me. I'm going to be laid up for a few days. Just don't hesitate. Give me a call. You've got to. And again, I know some people have told me, "Oh yeah, I'm going to send you my journals." Um, Two people did. Overprayed. Listen, you know, you don't have to show them to me ahead of time. But I will tell you one thing: there's a very high positive correlation with good grades and people who basically, kind of as a matter of habit, let me review their journal entries. I caution you, don't try to wing this at the 11th hour, 59th minute, and 59th second. It will be detectable. Would you fail the class? Most probably not. But you would probably be trading an A for a C. Don't let that happen. So listen, I will see you next week. Um, You've got my contact information. Just stay in touch. And again, my apologies for this. I didn't think that I would have to undergo the surgery. I thought the debridement would do the trick, but you know, it just didn't. And I hate to go through. Trust me, I'm no fan of surgery, but I do apologize. And I just thought that having these lectures, um, even though they're via YouTube, at least gives you continuity in terms of me covering the material the way I cover it. And it also gives you the benefit of familiarity with me. And it doesn't inconvenience another faculty member that tries to come in and pick up the ball, at uh, at a particular juncture in the semester. So, I hope it works out both ways. I'm going to be in touch with both Ilana and Ara to make sure they know that I'm not going to be around. But remember, you don't have to show up for class, but you gotta look at these videos and give me your codes. So please accept my apologies for any inconveniences. But sometimes I'm not that lucky. So I will see you next week. Bye bye now.